All right, welcome to Talk Tickers. Today, we're digging into Textron's third quarter earnings. And man, this one was a real head scratcher. You've got this classic Wall Street puzzle, a solid earnings beat, which is great, but then a revenue miss that just throws a wrench in the works. So, which one tells the real story? Let's figure it out. And really, that's the big contradiction we're looking at this whole quarter. You have management painting this picture of strength, a massive backlog, solid execution. But then you look at the market, and it's like they heard a completely different story. All they focused on was that top-line miss and some, let's say, soft spots in a few key areas. So we're going to unpack exactly what's going on with that disconnect. Okay, so let's start with the good news, the bottom line. Adjusted earnings per share, or EPS, came in at $1.55. And that right there was a really solid beat against what everyone was expecting. It tells you the company is doing a pretty good job managing its costs and keeping operations tight. But here's the number that got everybody worried: revenue. It landed at $3.6 billion. Now look, that's up 5% from last year, which isn't bad. But the problem is, it fell short of what analysts were looking for, and that created this immediate tension around the whole report. So when you put it all together, you can see the whole story right here. That EPS beat, it was about 5% above what the street thought. That's a healthy number. But the revenue miss, coming in somewhere between 2 and 4% below expectations, well, that's what really grabbed all the headlines. It just set this negative tone right from the start. All right, so to really get what's going on with those headline numbers, we've got to pop the hood and look at the individual business segments. And trust me, this is where the story gets really interesting. It's a real mixed bag of some really impressive stuff and, frankly, some clear weak spots. So just looking at the high level, you see revenue is up 10% in both Aviation and Bell. That sounds great, right? And for Aviation, profit just surged. Fantastic. But look at Bell. Their profit actually went down, even with more revenue coming in. And then there's this other number that just jumps off the page, the backlog. It grew by a massive $2.2 billion in just one quarter. That's a huge signal for future demand. And this right here, this just perfectly shows that split we were talking about. On one side, you have Textron Aviation. That's the business jet division, and they are just firing on all cylinders. Profits up a whopping $51 million because of great deliveries and a good product mix. But then you flip over to Bell, and oof, commercial helicopter deliveries dropped a lot. We're talking from 44 last year down to just 30 this year. Yeah, that is definitely a soft spot investors are going to notice. Just look at this number, $15.9 billion. That tells you the sheer scale of work they have lined up for the future. I mean, a combined backlog of almost $16 billion, and that's just for Aviation and Bell. That's a multi-year foundation of revenue that's pretty much locked in. You can absolutely see why management is feeling so confident. Okay, so let's shift gears and talk about the earnings call itself. Because despite all this skepticism from the market, CEO Scott Donnelly and his team, they came out with a really confident, really optimistic view of the business. They're standing firm on their full-year targets. And management's commentary. I mean, it was totally unambiguous. When they got asked about demand for business jets, the message couldn't have been clearer. The market is strong, period, across the entire portfolio. That's the story they're pushing, one of really durable, really robust demand. They also didn't shy away from the tough questions. They directly addressed the concerns swirling around that massive MV-75 defense program for the Army, the one for the next-gen military aircraft. And the key takeaway here was all about risk management. Donnelly basically came out and said, look, this is not one of those programs where we expect to lose money. It was a very direct attempt to calm everyone's nerves about the kind of crazy cost overruns you see all the time in the defense world. And you know what? They put their money where their mouth is. They backed up all that confidence by reaffirming their full-year guidance. They're still calling for adjusted EPS between $6 and $6.20. They're still expecting manufacturing cash flow of around $1 billion. And on top of all that, they're aggressively buying back their own stock, which is another huge signal that management thinks their company is undervalued. Something else pretty big came out of the call. They announced a major leadership transition. Now, this was pretty well telegraphed, so not a huge surprise. Longtime CEO Scott Donnelly is moving to executive chair, and Lisa Atherton, who's got a ton of experience running Bell and Systems, is going to take over as CEO in January 2026. The whole thing was framed as a very deliberate, very planned out succession. They're trying to signal stability and continuity to investors.
Okay, so this brings us right back to the central puzzle. If management's this confident, if the backlog is hitting record highs, and if the guidance hasn't changed, then why on earth did the market hate it so much? Let's break down that disconnect.
I mean, seriously, this is the question every single analyst was asking after the call. The pieces just don't seem to add up. You've got this super confident story from the company, and then a decisive thumbs down from investors. So, what did they see that management didn't?
Well, whatever it was, the reaction was swift and it was brutal. The stock dropped almost 4% the day the earnings came out, and on much higher than average volume, too. So this wasn't just some minor dip. This was a pretty significant rejection of the quarter. And this isn't just a one-day thing. If you zoom out and look at the whole year, Textron's stock is actually down almost 2%. Now, hold on. Compare that to the broader aerospace and defense sector, which is up over 44%. I mean, that is a gigantic performance gap. And when you're lagging that badly, investors have pretty much zero patience for any kind of misstep.
So, what really caused the sell off? Well, a few things. First, in a market like this, a top line revenue miss is just going to overshadow a bottom line beat. That's just how it is. Second, that weakness we saw in commercial helicopters at Bell, investors saw that as a potential crack in the whole robust demand story. And finally, when your stock is already underperforming this badly, investors are demanding absolute perfection. And let's be honest, this quarter just wasn't that.
All right, so let's put it all together and figure out what this means going forward. We call this the next call. It's our take on what you should be watching for next quarter and our thesis on where the stock is headed from here. So with this weird backdrop of solid fundamentals on one side and some pretty clear market skepticism on the other, what's the most likely path for the stock, right? How should you be thinking about the next couple of quarters? Here's how we see it playing out. First, Q4 is usually a strong season for aviation, so expect that. But the market is going to be watching margins and the exact number of jet deliveries like a hawk. Second, the big catalysts are super clear. They need to get the new Ascent business jet certified. They need to hit their milestones on that big MV-75 military program, and they've got to win some new contracts at the systems division. And until those things actually happen, we think the stock is probably going to be stuck in a trading range, just waiting for a clear sign of some real positive momentum. And that brings us to our final rating, market perform. Look, the company is actually executing pretty well, and that backlog is genuinely impressive. But the stock is just fighting this huge headwind of underperforming the sector and a ton of investor skepticism. To break out and earn a higher valuation, it really needs to deliver flawlessly on those key programs. No more slip-ups.
So, that's our take on Textron's quarter. And as always, please remember, this explainer is for informational purposes only. It is not financial advice.